AI is the defining investment theme of the decade. Trillions are being deployed, valuations are skyrocketing, and everybody wants to dominate. But the real question for investors is simple. Who will actually win long term? Some say Google with its unmatched access to YouTube data. Others believe OpenAI, despite its rise, may be more fragile than it looks. In this video, we will look at this from different perspectives. Let's get started. On one side, you have investors who believe that Google will eventually own the best AI application. Data is the oxygen of AI, and no company has more free, user-generated data than Google does. Think about YouTube alone. It is the second most visited website in the world. Ironically, right after google.com. Over 500 hours of video are uploaded every single minute, and more than 2 billion logged-in users visit the platform every month. That is a flood of video content, captions, descriptions, and user comments. It is an endless supply of training data that is almost impossible to replicate. Now, compare that to OpenAI. ChatGPT has been incredibly successful, but it doesn't own a massive platform like YouTube, TikTok, or Instagram. It doesn't have billions of users creating content that can be then fed back into its models for free. And that could become a serious disadvantage over the next 5 years. Google has already shown parts of this potential. One of the most surprising examples came with the rebrand of Gemini a few months ago. For a short while, it even overtook ChatGPT in app downloads. This surge was driven by the latest AI image generation update. That was it, the Nano banana moment. A reminder of what happens when Google leans on its ecosystem. As they write on the website, Gemini image editing is nano bananas. With the Play Store, Android devices, and its wide distribution network, Google can redirect consumer attention almost overnight. Very few companies in the world can do that. But apps and downloads are only part of the story. The real upside might come from Google's next move in video AI. And that brings us to Veo 3. Veo 3 is Google's next-gen video AI, which is capable of creating and editing videos. The reason investors are so excited is simple. No other company can train a video AI on the kind of scale Google can. Remember, video is the most expensive, most complex form of content to create. That is exactly why user-generated video content is priceless training material. OpenAI, for all of its breakthroughs, doesn't have this kind of free video data. ByteDance has TikTok, Meta has Instagram and Facebook, and Google owns YouTube, the world's top video platform. If Veo 3 delivers, it could give Google a competitive edge that is almost impossible to match. OpenAI is growing rapidly, but its growing revenue comes with fast-growing costs as well. Unlike Google, Microsoft, or Amazon, OpenAI doesn't have a giant cash-generating machine behind it. Google has search ads, Amazon has AWS, and Microsoft has Office and Azure. Those businesses print billions in free cash flow every quarter, money that can be then reinvested into AI research and infrastructure. OpenAI doesn't have that luxury. Reports suggest that they are planning to borrow and burn $115 billion through 2029 just to fund their operations and growth. But what happens if the market cools or investors lose patience as competition heats up. History tells us that capital markets don't stay wide open forever. We saw this in '01 during the dot-com bubble as well. And we could be heading toward a similar correction in AI at some point in the future. When you step back, the AI race looks like it is splitting into two main areas: consumer AI and enterprise AI. On the consumer side, the winners will be the companies that own the platforms where billions of people create and consume content. ByteDance with TikTok, Meta with Instagram and Facebook, and Google with YouTube. These companies aren't just generating data, they are generating the exact kind of rich, unstructured human content that AI thrives on. On the enterprise side, the story looks very different. Here, the dominant players are the companies that already own the software and the data infrastructure of businesses. Think Oracle, which powers databases for about 60% of the S&P 500 companies. Or think Microsoft, with its Office suite embedded into every corner of corporate life. These companies are sitting on decades of structured enterprise data, and now they are layering AI on top of it. The companies that aren't part of either of these groups will have a huge challenge going forward. But hold on. Before we bury OpenAI, it is important to recognize what they have achieved. ChatGPT has built a massive consumer base. It was the first app in history to reach 100 million users in just 2 months. And its weekly active users has been doubling every 7 or 8 months since then. They are also making a strong push into enterprise AI. They are offering solutions that could become embedded into workflows the way Microsoft Word or Salesforce once did. One of the key questions is, can they fund that expansion long enough to keep their lead? They have the brand recognition, the developer ecosystem, and the momentum behind them. Some argue that they have already won the consumer side of AI and are simply expanding from there. Tech history is full of companies that looked unbeatable until they weren't. Netscape was the first dominant web browser, but Internet Explorer took over. Yahoo once defined search until Google came along. Nokia and BlackBerry owned the mobile phone market with over a 40% market share, but then Apple and Android wiped them out. MySpace was the leader in social media before Facebook. If they execute well and have the resources, they can win as well. Some investors are starting to get jittery. Between 2023 and 2025, the 3 hyperscalers, Google, Microsoft, Amazon, plus Meta and Oracle, spent about $825 billion on CapEx. And across the entire industry, that number was over $1.2 trillion. At some point, markets will demand to see returns. Right now, it's a land grab. Spend, invest, experiment. Take Salesforce as an example. In 2024, it was a poster child for agentic AI. Its stock hit an all-time high, but by August 2025, it had fallen to a 52-week low. One major factor was an MIT study showing that 95% of companies investing in AI reported zero measurable return. Although I believe that it is a bit of a stretch, but still directional. And I also believe that at one point, that is exactly what investors are going to be watching. The market won't tolerate years of massive spending with no payoff, or will it? History suggests patience runs out with time. And the MIT study showing that 95% of companies saw no return on AI investments is a stark reminder of that risk. What's clear is that not everyone can win. Some companies will rise above others and capture not just market share, but profitable market share. Thanks for watching, and please give it a like, subscribe, and watch another video. See you in the next one. Thank you. Bye.